Good morning, everybody. I recognise quite a few faces in the audience, so lovely to see you again. To those of you who don't know us, where have you been before? Okay, right. Let's start with a bit of fun for a minute. This is one of the 8 AdEPT technology branded taxis in front of one of our customers, because we kit out 5 floors of the Shard. 24th, 25th floor is one of those very trendy business centres. We do about 200 business centres across the UK, mainly in London. Floors 4, 5 and 6 is a private hospital. We do 70% of all the private hospitals in London. My challenge is simply this. If you spot an AdEPT taxi, send me a photograph and I'll send you a bottle of champagne, right? That sounds easy, but trying to get your phone out your pocket in time to watch it going past, believe me. I don't spend money very easily, don't I?
You've been taking photos of orange taxis all over London.
My name's Ian Fishwick. I'm the founder. You are?
I'm the Group MD, recently recruited.
I'm John Swate. I'm the Group FD. I've been working with Ian and the rest of the team for 11 years now.
So basically the way this works is, I mean, John will do the numbers, obviously. We're an acquisition vehicle. So Phil runs the things and grows it organically, and then I sort out the acquisition strategy and we buy things, and we'll give you some examples later on. Okay. Right, I'm going to start a little bit differently, because this is one of those businesses that's not new. Okay, we were founded in 2003. We've been on the market since 2006. 43% of the stock is owned by directors and family. Why have we not sold it and invested in something else? Because at the end of the day, we're private investors like you guys. So I'm going to share with you, rightly or wrongly, why we've still got our own money in here, because obviously we're very, very aligned with the shareholders' interests. So the first bit is, I like predictability. 80% of the revenue is recurring monthly subscriptions. It just comes in all the time. I like visibility. The next bit is, I like businesses that actually make some money. We've been 6 or 7 percentage points higher on EBITDA margin than our peers forever. Okay, so it says about 20%. The interims were out a few weeks ago. It was 21.2. Okay, so it generates real profits. There's no point. I grew up with Lord Weinstock. You know, I'm an absolute cash king man, like a stick of rock all the way through. There is no point having a business where your profits are every year invested back in capex and you never generate any money. So very simply, we want 1 to 2% of the revenue on capex and no more. It's currently around about 1. And if you do it that way, what you've just invented is a cash machine. Recurring revenue, turning into profits, not doing loads of capex, cash machine. Right, so it's oscillated over the years in terms of cash conversion from 80 to 110%. It's 80 at the minute, and that really depends on basically a working capital supplier being paid before or after the period end. Okay, if you're somebody who likes free cash flow yield, then it doesn't matter whether you want to calculate it on a levered basis or an unlevered basis. It's 5 to 8% range, always has been. Right, in this environment, phenomenal. I know that some of you, by the way, are fans of Stockopedia. If you want to look this morning, ranked at 94. Okay? Do it another way. Hughes, the chairman of Downing, our friends at Downing, our biggest institutional investor, ran an analysis using FactSet of all the stock exchange information and said, you guys have got such a long track record now, let's look at it compared to everybody else. There's 941 companies on AIM. There's only 3 grown earnings per share every year for 9 consecutive years. AdEPT, IMART and Churchill China. Now, John will show you in a minute that at the half year, we were 12% ahead on earnings per share already. So it's pretty nailed on now that we will get a decade of consecutive growth. So we're doing something right. Over the last 3 years, we've done quite a big change. We started as a telecoms business, selling calls and lines, and then managed networks. Then we went inside the building and did unified comms, which is simple English is all the devices, make them all talk to each other, also sort out the Wi-Fi. And then we said, while we're here, let's go and do all the IT as well. So it's everything from laptop, desktop, all the way through to cloud and everything in between. Focused originally on London and the South East, but you'll see in a minute, now that we've got the hang of most of these businesses, we're moving the geography out across the UK, but also focused on public sector, for all sorts of reasons. Main one being the government is trying to get a third of all public sector spend with small and medium-sized businesses. It's not going to the small businesses, it's going to the medium-sized ones. So we're swimming with the tide. It's also, in a Brexit world, a safe place to be.
When we do investor briefings, we often ask, what's the market opportunity and what's your market share? So I thought I'd expect that question here. So I Googled how many SMEs, we do a lot of work with SMEs, how many SMEs there are in the UK. About 4.7 million. And we provide services to 15,000 organisations, the majority of those are SMEs. So you can see there's a lot of run rate in terms of opportunity. Also, because we deal with 15,000 organisations, and if you look at the acquisition journey that we've been on, a lot of those organisations are only buying one thing from us. I'll come on to a proposition slide later in the deck. The opportunity to sell multiple things to those organisations, as Ian said, moving from the connectivity to the telephone to IT, gives us a great opportunity, not only within our existing base, but also in the broader marketplace. And if you look at the marketplace at the moment, 29 billion, well, we turn over 57, I think, our run rate revenues. So again, the opportunity to tap into this substantial marketplace is there for all to see. I joined the company about 8 weeks ago. My background is very much in the technology space, outsourced IT. So I've been on a voyage of discovery with Ian, walking around our organisation, talking to customers, talking to suppliers. And I was really keen to bring together all of those things and really understand what we take to market. And I think you can see here, and again, it goes through the acquisition journey. Our heritage is the telephony space and the networks and the unified communications, but increasingly we're spreading into provision of technology. And I think the best example of this, I went into one of our prospects, and it was a media company, central London, about 50 employees. And you just tell the story to this organisation. You say, well, who looks after your technology? You've got some Apple kit in the office. Who supports those if it goes wrong? You've got some data on a server. Who backs up that server? When you extended your office, who cabled that office? And when you explain and talk through the things that we do, you say, was that a simple and enjoyable experience? And the look of horror on the chap's face at his experience of trying to pull all this together for an SME, you can see if we take that proposition to market and say, look, we'll make this simple for you. We'll take all of that off your hands as an SME. The look of relief on his face was quite an interesting one. And I think that's the opportunity that we have in the market. If you look at our heritage was as an architect. So bringing together a number of the different players in the marketplace and collecting those and presenting a solution to a problem. But increasingly we're realising that we can actually be a manufacturer as well. So we can combine all of this capability and present a solution and own that solution as part of our proposition. And if you look at the solution on the left-hand side, we have massive credibility in each of those orange boxes, and we can present all of that capability to a client who, to be honest, doesn't want to deal with the complexity, just wants a solution for their technology problem. And I think that's what we're bringing to the table. In terms of our geographical presence, when we do presentations, one of the key things is just to emphasise that we're not exposed to this Brexit chaos. We don't have to worry about currency exchange rates. We're very much focused on the UK, and with 4.7 million potential customers, that's a pretty decent market to run at. We don't have to travel globally. Our focus historically has been on the southeast, and if you look at again a sort of a wonderful quote from Ian. Can you think of someone who dominates the IT outsourcing marketplace in London, for example? And actually most people can't even give an answer, let alone decide who's the most dominant organisation. So the opportunity to consolidate this marketplace and become a major player in, in the southeast, let alone the rest of the UK, is quite substantial. We have a resilient office location, so we can pull talent from different towns across the UK. Joining those up is something that's quite straightforward. But you can see we're starting to move north. We're not attacking the Celts. We're not sort of heading quite that far north. But we're sort of moving north. We recently made an acquisition. Ian will explain the logic behind that. But we recently made an acquisition in Wakefield. And if you think about the Northern Powerhouse, it gives us another tranche of organisations that we can take our propositions to. The other thing that I've found fascinating, so we had a sales conference in the Houses of Parliament, which is yet another customer of ours. I asked the sales team, I said, give me some big numbers. I'd love to talk about some big numbers to the august audience at Mello. So they gave me some numbers that start small, but are actually brilliant numbers and actually become quite stellar. And goodness, I'd like to understand what a petabyte is. But it's really important, customer satisfaction. So there's a lot of organisations that do what we do, bring together all of that complexity, but actually delivering customer satisfaction and profit and growth is actually quite a challenge. And if you look at our staff satisfaction, again, staff turnover very low. So we've got great staff satisfaction, great customer satisfaction, growth in revenues and margin. That's sort of a pretty impressive story. So yeah, you look down here, 4.8 out of 5. We constantly monitor customer satisfaction. In terms of some of the sites that we connect in the health arena, we've got over 400 sites, hospitals. Again, Ian will cover this a little bit later, but hospitals, hospices, doctor surgeries, we connect those up with high-speed fibre networks. Over 3,000 schools we support in London. So again, for an organisation such as ours, we allow teachers to teach and we look after the technology. 2,000 hosted desktop users, one of the biggest Microsoft estates in Europe, if not the biggest. I think it might even be the biggest. And then straying into some quite stunning numbers, 27 petabytes of data that we back up. So organisations trust us to look after their data and make sure that when they turn up in the morning, their information systems are up and running.
Let me just add one to that bit. Okay, we have over 1.1 million Office 365 users. In Microsoft's words, it's the largest single deployment in the whole of Europe. Web filtering, security, it's not going to go away. We're web filtering 1.2 billion images a day. This is a serious scale.
So some pretty impressive numbers for an organisation of 248 employees. Okay, I'll hand over to John.
So in terms of the revenue, the split of the revenue, we are a traditional telco. That was our heritage when the business started back in 2003. Since 2015, we've been on a journey of a transition away from the fixed line piece and into managed services. We're like every technology company. We've got products which are shrinking, we've got products which are relatively flat, and then we've got the growing products. So for us, it's about managing that transition from the grey traditional fixed line piece into the managed services. So the fixed line piece of the business, 26%. If you'd looked at that stat 3 years ago, that would have been 75% of our revenue sitting in there. Now that's got industry average revenue reduction on it to about 8 to 10%. That's what we're seeing across the industry, partly through people transitioning onto new technologies, using other methods of communication. But we're actually starting to accelerate that move as well as we're transitioning our own customers that are in the fixed line piece, moving them across into new technology on hosted SIP and VoIP services. In terms of the managed services piece, that's where the acquisition focus has been recently. The most recent acquisitions since 2015 have all been in the managed service space. That's also where the organic contract wins and new business are coming in, and we're currently seeing 3% organic growth on that piece of the business. So in terms of the earlier graph you saw on the market segments, the grey piece was the two bottom segments, and we've seen them flatten out and also see them declining, which is why we've moved into the top two segments, which are the growing parts of the market.
If you look at the commercial and public sector mix, we've got 15,000 sites. We've got some pretty awesome brand names. We've got a slide sort of covering those. But for example, the office estate in London, I think it's 70% of the offices in London.
It's about 200 business centres.
That's right.
Probably over half of all the business centres opened in the last 2 years are ours.
Yeah.
Okay.
So quite an impressive customer presence there. So here's some of the organisations we deal with. Sabre Insurance is a good example. We provide the backup and disaster recovery capabilities of Sabre. A highly regulated business. Actually, the financial regulator ensures that these organisations have got the right disaster recovery capability, and we're providing that. Marston's Breweries, we provide telephony and connectivity services to a number of their pub chain. So you can see some pretty impressive organisations that we support.
You may have spotted Coca-Cola, by the way. Okay. A third of it is public sector. I sit on the Cabinet Office SME panel representing the IT and telecoms industry, so I'm in the middle of trying to negotiate what are the barriers we need to remove. I think we've done all right so far on the basis of there's 400 odd councils in the UK, we're now in 109. The Houses of Parliament, the Parliamentary Digital Service is AdEPT, part of the Cabinet Office is AdEPT. We said before that there's over 3,000 schools with over 2 million users. It says over 20 universities because it keeps changing. In reality, it's probably about 25, 26 universities and over 100 colleges. The over 20 NHS trusts has gone up again because we've just won the Kent Health and Social Care Network. So the next 18 months, we'll be building the network to connect nearly 400 hospitals, hospices and GP surgeries all across Kent. So it's something like 25 to 30 NHS trusts now. And I suspect some of you in the audience have got private medical insurance. Anybody you'll ever heard of, Wellington, Portland, Shard, Harley Street, Guy St Thomas, they're all ours. Okay, we dominate that sector. So in terms of public sector healthcare, I think we're punching massively above our weight.
So as I mentioned, we're a manufacturer and also an architect of solutions using third parties, and the strength of our relationship with these third parties enables us to be price competitive, but also provide highly sophisticated solutions to our clients. And you can see the organisations that we deal with and the importance of those organisations. And I was at Glen Eagles, which is a big conference for the telephony space recently. And what's obvious to me is you're seeing consolidation of some of the supplier base. So the likes of BT and Talk and Virgin, that marketplace is consolidated massively. But there's still a distributed retailer space, if you like, given the number of organisations that we as companies have to engage with. So it's absolutely vital that we have very strong relationships with these providers so that we can take these solutions to market. And they are desperate to work with organisations like us to take their propositions to market.
I'm not going to bore you to death with awards that we've won, but when you start to see things like the Global 100 Awards, we were best comms and technology supplier. We're now officially one of the top 25 technology companies in the UK. We've been winning awards like that now consistently for 4 or 5 years. Okay, so it's just telling you that you're not dealing with somebody who's brand new. Okay, in terms of this kind of things, we've got all the ISOs and the certificates that you need to do this. It's very unusual to see Microsoft and Apple on the same slide. We're partners with the government Crown Commercial. This one is interesting. Institute of School Business Leaders partner. So that's how you get things like 3,000 schools.
So we recently announced the interim results for the 6 months to September 2018. These are just a few of the highlights. A very strong P&L performance, so revenue up 10% to 24.4 million. Flowing through with slight economies of scale down at the EBITDA line, that's up 11%. And then converting into profit after tax increase of 13%. Flowing through into earnings per share of up 12%, on the back of which we announced a 15% increase to the dividend. So it was a good performance for the half year, and we're expecting something similar for the full year. We just flip over onto the revenue. So we're currently 57 million run rate. You won't see 57 million in this year's statutory numbers because we've got part year contribution of 2 acquisitions that we did, Shift F7 in August 18 and ETS more recently a couple of weeks ago in November, which Ian will come on to shortly. So at the half year, 10% revenue increase. As Ian said at the start, we're all about a stable business model focused on recurring revenue, trying to achieve 80% recurring, so we were 79% recurring this period, so good stable visibility on the revenue stream. And then conversion into profit. So EBITDA, as Ian said earlier, we were founded in 2003, we're not new. This is our 16th consecutive year of first half EBITDA growth, and we're pretty nailed on for a full year EBITDA growth, so that'll be 16 full years. With the full year contribution of the 2 acquisitions we've just done, we'll be just below 12 million EBITDA run rate. 11% up in the half year, 44% across the last 2 years, but still maintaining that high EBITDA margin, 21%, typically 6 to 7 percentage points higher than most of our peers. We've always oscillated in the range of 19 to 22% EBITDA margin.
Now, let me just take that point. What you saw was a pretty amazing transformation where we went from 75% telco down to 25%. What we've shown you now is every single business that we've ever touched, we can get to the same model. Over 80% recurring revenue, 1 to 2% capex, knocking out 1% EBITDA. So we're showing that you can do that in technology wherever we go. It's an approach, not a product.
In terms of funding the business, we've done 26 acquisitions to date, all of which have been funded through debt. We have a 35 million revolving credit facility that's funded 50-50 between Barclays and RBS. At September 2018, we were 25.1 million senior debt with Barclays and RBS, and we also had a 7.3 million convertible loan from the BGF, which is actually excluded from the leverage covenants. In terms of the debt, the absolute quantum of the debt is not the key thing we're keeping an eye on. It's actually what's happening to the leverage multiple and trying to manage that position. So at the half year, we were 2.4 times net debt to EBITDA. What we're seeking to do is maintain some headroom below the 3 times covenant that we're on with the banks. Not a particular issue for us because being so cash generative, converting 80% of the EBITDA into cash flow, we are able to pay down the debt. What we accept is that at the point that we do an acquisition, we'll probably peak on the net debt multiple. We have a tolerance limit of around 2.6 times. But what we want to be able to see is that leverage is going to get down to 2 times or below within 9 to 12 months post-acquisition, assuming there's no further acquisitions in that period. By year end, won't see much change in the leverage multiple because we had a couple of significant cash outflows post-period end. We paid the earn-out on the Atomide acquisition that we did in August 2017, 1.5 million. Went out in October, and then more recently we've just done the acquisition of ETS Communications, so a further 2.5 million went out on that acquisition.
Just pause for a second, John. Some people say to me, well, why have you got any debt at all? It's dead straightforward. If we stop buying things, we could go cash positive quite quick. I think some of you in the audience might realise that £1 million in the bank with these interest rates doesn't actually generate an awful lot of income, right? If I can't find something better to do with £1 million than put it in the bank, that's not a strategy. In an era of low interest rates, you should use the strength of your balance sheet, but do not get risky. That's the basic tack.
Given your strong growth and very strong cash flow and the very steady increase over the years, and I have to say I'm an investor, so I've been watching.
Thank you.
Have you considered issuing a bond, which would probably be more secure, and before interest rates start to go up again, might be a good time to do it?
We've had a look at all sorts of things. It is the reality of it. The beauty of the arrangement we've got is it's not high in terms of interest rates. We might look at hedging it, but it's a revolving credit facility with an accordion facility, which for those who are not used to that, what effectively means is we've almost got money on the shelf, agree with the banks, and we just keep pulling it down at the same documentation and rates every now and again, because as we're growing, we keep outgrowing our bank facility, right? So for example, the 30 million facility we had recently was really a 3 times 10 million EBITDA net debt. Well, we're almost at nearly 12, so we'd outgrown it. So every now and again, you'll see us pull another 5. So it's that flexibility that we like.
Like an offset mortgage, I suppose.
Yeah.
In a sense, yeah. Okay.
Good analogy.
The thing that we're keeping an eye on, as you'll be interested to, is the earnings per share. What's happening to the earnings per share? No point doing these acquisitions if they're not accretive in terms of earnings per share. So up 13% year on year to 3.7 million profit after tax, and earnings per share up 12% to 14.5 pence. And as Ian said, you know, one of only 3 AIM companies to increase it 9 consecutive years. We're pretty nailed on for the 10th consecutive year this year, so we'll see if the other 2 businesses can keep up with us.
Will they? You think they will?
It's IMART and Churchill China, so you can look them up for yourself. Dividend policy, not only are we profitable, cash generative, we're also paying a dividend. We operate a progressive policy. A 15% increase to the interim dividend this time round, with 3 times dividend cover, so plenty of cover in there. Anything north of 2 times is comfortable for us. And typically we've been paying out about a third of cash flow. So a good return for investors as well.
Just before we throw it up to questions, I'll just give you a flavour of what's happening in the last 3 months. So those who've been watching us for a while realise we've been buying things for a while. So in August we did acquisition 25, right? In November we did acquisition 26. We tend to split acquisitions into two piles: things we do for economies of scale and things that we do for new skill sets. You know, if you enter a new area, then you need the engineers and whatever. Okay, so the one we did in August was a skill set one. We bought a business, 5 million turnover, Shift F7. Why did we do that? Because we couldn't find any IT outsourcing business with more than 5 million turnover in London. We buy one out of every 12 we look at. So John and I have looked at something like 300 IT telecoms type businesses over the last decade, right? So if we can't find one that's more than 5 million, it means there probably isn't one, okay? This was our second one, so now we've got 11 million turnover in London, but specifically, these are backup specialists. They back up over 1,000 servers every night, okay, and replicate them. So we now have that extra technology where if you go down, we can instantly put you back up again, right? So it's an extra skill set. In November, we did one very quickly. They're a bit like buses. Sometimes there's a gap, and sometimes we do them quite quickly. We bought one in Wakefield. It was the first time we've moved north. But we did it because it's exactly the same technology as we've got in Northampton. So those two businesses will start to work together. They're only two hours apart. But also, they've got hosted voice in over 200 GP surgeries. Now, if you remember me telling you, we've already got 70% of the private hospitals. We're now building the new Kent Health Network. And we've now got the ability to do voice for GP surgery. So there was a lot of strategic logic in doing that. So you'll see us keep looking at, do we need more skill sets, or are we going for economies of scale? Questions to the floor?
I think it's great that you've got margins above 20%. That's very, very well done. But what allows you to have margins that are 5 or 6% percentage points higher than your competitors?
Fundamentally, it's OPEX. In a lot of the business, we're buying products at similar-ish times of costs as other people. It's all about, wherever you can, automating your back office. I'll give you some ideas. The original Tunbridge Wells business, which has probably got 13,000 sites, has got something like 27 people.
I think there's a couple of other things that I've seen in the last 8 weeks of joining the business. There's very rigorous control in the organisation. We have weekly reviews of operational performance, and that rigour is where the profit is. I mean, I've worked in very large organisations without that rigour, and that's where profit just walks out the door.
I mean, give you an example. We are quite dull people, by the way. We are consistent. We are very, very good at being boring and consistent. We reforecast this year end and next year end every Monday morning and have done for 15 years. At the end of every director's meeting, you say, what changed since last week? And it can be as simple as somebody went on maternity leave. You know, we are absolutely watching like a hawk, because the longer you're looking ahead, the more chance you have at getting yourself ready to anything that can go wrong, right? So the amount of rigour and control in this is huge, okay? Give you an idea, the sales meetings are every single week. The reason why I want Phil to start running sales meetings is because I've chaired over 1,000 sales meetings in the last 15 years, okay? It's that detailed.
Yeah, on that 15,000 clients you say you have, how many of them quit every year and why? And how many people come to you every year and why?
Right, okay. So the simple question is, how many customers leave and why?
Yeah.
That's it really. The answer varies slightly to businesses. In the original business, the original telco business, probably about 8 million of the 57, so let's put it in context. At that end, small businesses at the end of the contract will simply go on Google and try and find the next prices. Right? So the industry standard churn at that end is about 10% per annum. This afternoon, we'll go and do a finance review of one of the IT businesses, and one of the questions will be, did anybody leave and can you name them? And I'm not joking. Because if one leaves, it's so rare, they can normally physically name them, okay? And that's a standard question in the finance reviews. Has anybody left and who was it, okay? And the way I try and explain it is, if if anybody's tried to move house, the process of moving house is so complex and stressful, you don't tend to do it. Bring that into business. The more products and services you sell to somebody, the more stressful and difficult it is to leave. That's the path we're going down.
But by the way, we don't rely on stress to keep them in. it's customer satisfaction is what we rely on to keep them in.
As you get larger and are now, are you finding it more difficult to find acquisitions that fit your bill relative to your size?
Okay, so I do acquisition strategy. Let me take that. No. What's actually happening is, as we're broadening the products and service range, there's a wider catchment of businesses that we previously hadn't looked at, is the first bit. So broadening the range took us up to about, say, 1,500 targets. Removing the cap of saying we were originally only looking in London South East, now we're going nationwide, that catchment area has moved to about 3,000 businesses in our target area. No matter how long I keep buying, I think I'll die before I get any dent on the 3,000. There's loads of them. Okay, we're looking at businesses every day. Okay, literally.
What is your biggest bottleneck for growth? We've already mentioned about acquisition, but what about employee skills and customer acquisition?
Yeah, that's a really good question, because if you read any sort of business books, they're talking about there should only be one bottleneck in a business. You solve that and you'll find another one. So, it's a really tricky one. I don't think it's skills. I think we can tap into skills. And if you look at our recruitment list, it hasn't got hundreds of people and vacancies. So I don't think it's skills. I think it's always hard to win customers. We talk about the challenge of retaining customers, and in the managed service piece, we do have literally single digit in terms of defections. So I think acquisitions is always a challenge, and that's why we're acquiring as well as selling. And I think that's probably the biggest bottleneck. But with 4.7 million potential customers, the challenge is making us attractive so that we're bringing those through the door.
I'll give you an idea. On Monday morning when we did the recruitment review, there were 3 vacancies out of nearly 250 people. And on the basis it takes like 2 or 3 months to fill them, it gives you an idea how stable it is.
I mean, do you see cloud-based telephony services as a sort of future area of growth for you, given that you've come from a telephony background?
Yes, and we sell a whole range of solutions. We are very strong with Avaya, so we're with Avaya and BT Wholesale on hosted. We also work with Ericsson, LG. We've got our own bespoke education VoIP that we've written ourselves, which is specific for schools. We've got all sorts of solutions for that.
How fast is it growing? And what's the take-up rate? Because
I don't think that's the fastest growing part of the business, to be honest. I think it's more in the IT and cloud services. Okay, so that's positive, but not massively positive. Okay, now it might start to move over the next few years, but that's not the bit that excites me. I think for the video we've just run out of time, so thank you very much indeed for a packed house. That was really nice and encouraging for us. Lovely to see you.